Good morning, good afternoon, good evening, depending on when and where you are listening from. Nick Gumpert here with Remax Top Producers, and I just wanted to share some objective information with those of you interested in the real estate market as we stand today. We're at the end of March 2022, and interest rates is the talk of the town, right? Whether it be on the news, through social media, etc. So I just wanted to give some context because, again, I think headlines do more to terrify than they do to clarify. So I'm coming in here and trying to give some clarity based on where we're at and what you can expect for the spring market. So let's jump right into it. Mortgage rates continue to move up. They have moved up nationally about 1.3% since December 30, 2021. So we're talking about just over going on 3 months now that we've seen interest rates rise about 1.3%. So something to be aware of for those of you looking to make moves still within this real estate space. So let's dig into what Sam Cater had to say there at Freddie Mac this week, and that was as of March 24th. The 30-year fixed rate mortgage increased by more than 0.25% as mortgage rates across all types continue to move up. Rising inflation, escalating geopolitical uncertainty, and the Federal Reserve's actions are driving rates higher and weakening consumers' purchasing power. So again, as interest rates rise, be mindful it does unfortunately have a negative impact on your ability to then stay at that same price point. You now need to look at a lower price point if you're concerned about making and maintaining an affordable monthly payment based on the budget you've come up with. So in short, the rise in mortgage rates combined with continued house price appreciation is increasing monthly mortgage payments and quickly affecting homebuyers' ability to keep up with the market. Again, this is prospective homeowners, not current homeowners, that it's presenting the biggest challenge for and to. Mortgage rates. So this is what we've seen. We've seen those rise. So as you can see, December 30th, this is again national. It's not locally. And again, your rate is going to be dependent on your credit score. So this is giving you some numbers on average, it's fair to say. Nonetheless, you can see again, they've risen about 1.3%. So for those of you that have listened to any of my content in the past, I've referenced the 1 to 10% rule when it comes to interest rates and your buying power. So for example, we've gone over 1 full percent, unfortunately, with interest rates climbing. So what does that mean? That means if you qualified for a $500,000 loan at 3.1% interest rate, you now need to look at a $450,000 purchase, not a $500,000 purchase, about $450,000 once rates hit that 4.1%. Okay, so that affected your buying power by 10%, unfortunately negatively. Now we've inched up above that 1%, so now it's taken a knock-on effect. And now you're realistically, to keep that same monthly payment that you had for a $500,000 home at 3.1% interest, now that we're at 4.42, now realistically you need to be looking at a home that's in around $420,000. So that's just the reality we live in. It is what it is, but make decisions accordingly. So A, you don't play that card of, well, if I would have known that, I wouldn't have wasted my time looking at X, right? So again, I'm trying to give you the context so you can make confident decisions as you look to move forward in the spring market. Impact of rising rates on home prices. This is an interesting one, so pay attention here, please, because rising interest rates do not mean house prices come down. As you can see, historically, they've actually bumped up, and in some cases, significantly higher, even though interest rates have risen. So again, this is objective information, not my opinion. So you can see dating back to almost 30 years, there in December 94 was the end date of when interest rates rose. They ended up between 93 and 94, increasing not quite 2.5% fluctuation, right, over a 14-month period. But home prices still appreciated a little bit better than what interest rates rose. So again, be mindful of who you listen to and what you hear, because again, headlines tend to terrify, not clarify. And again, I feel that's my job as someone you know or may want to know, is to give you a bigger scope of what's really going on. And then again, it just sprinkles in different moments that we saw interest rates rise over 1% and what the knock-on effect was when it came to home prices. And again, you can see there was never a time historically speaking, up to this point in time, that home prices declined and depreciated when interest rates rose. So that's the facts being what they are for where we've been. Mixed impact of rising rates on housing, and I say that because the home sales do decrease. Why? Because it takes more people out of the market. Why? Because your buying power, unfortunately, gets negatively affected as interest rates rise. So that's the reason for the home sales declining at the percentages at which you see there on the right that are boxed out. So just be mindful. Context matters, right? And as you navigate your own individual scenarios, just be mindful. Home sales, again, you will see in the news, home sales are down. Why? Because people don't afford or aren't able to afford at the same price point they once were. So some just choose to drop out and say, you know what, I'm going to wait. Unfortunately, you also have house appreciation that continues to go up, as you can see in the home prices. Again, that's just the facts being the facts. So let's look at what Len Kiefer says here with Freddie Mac. He says, mortgage rates are likely to continue to move higher throughout the balance of 2022, although the pace of rate increases is likely to moderate, meaning it's likely to slow down. We have seen again, 1.3% rise in just these first 3 months. We don't expect that to be the case sustaining throughout the rest of the year. Much of the increase in rates in early 2022 is in anticipation of what will happen later this year, especially with the Fed interest rate policy. So again, the Fed controls things on the back end to help deal with the inflation that we're all experiencing. And so a way to moderate that is to raise the interest rates. And again, unfortunately, that's a negative effect for those of you looking to buy a home. Last couple slides here I wanted to share with you. History suggests that when rates rise, there is an initial bump in home prices as many move quickly to buy a home before rates increase further. But after that period, home prices slow. Freddie Mac analysis shows that a 1% increase in mortgage rates results in home price appreciation that is 4 percentage points lower. And your mind might be blown right now. So for instance, a 1% increase in mortgage rates, which we've seen already, lost my train there. A 1% increase in mortgage rates would change a home price growth from 11% appreciation to 7% appreciation. Again, that's on average. So in Southern California, they projected us to be in and around 10% appreciation there in January, February, based on what we did last year in 2021, which was over 19%. So if this, what you're seeing holds true based on historical data, that would mean, okay, if price appreciation was projected in early 2022 to be in around 10%, suffice to say that it's probably going to end up in around 6% appreciation. With that said, home buyers, things do not stay the same. So the prices you're seeing now, they are going to climb. And that's just, again, the reality with which we live in. Here's my final slide for all of you out there. With rates rising and expected to rise through 2023, it makes sense to obtain a purchase, or refinance mortgage if you are in good standing. So don't let these initial bumps and increases in interest rates deter you to say, oh my God, all the wheels are going to fall off. That's not the case. Again, it's the Fed's way of moderating the inflation that we've all been dealing with. And that's the knock-on effect. So as long as you're in good standing, it still makes sense, because when we compare ourselves to the 80s, the 90s, the 2000s, we are still at a much lower interest rate than those decades, than those prior decades. So if I can help you or anyone you know in any way, I'm here as a resource. Feel free to reach out at your convenience, and hopefully we'll talk soon. Have a good one.